Good afternoon, and can I welcome members, invited guests and the public, both here and people watching on the webcast, to today's meeting of the London Assembly Economy Committee. Our main topic of discussion is the Mayor's role in promoting financial inclusion, and we encourage anyone who's taking part in the discussion on social media to use the hashtags either Assembly Economy or Access to Money. First of all, we've got a few very short items of formal business that we'll go through before we get to our witnesses. Do we have any apologies?
We have apologies for absence from Assembly Member Arnold, for whom Assembly Member Desire will be substituting for. We've received apologies for absence from Assembly Member Bailey, for whom Assembly Member Arbour will be substituting for.
And can I ask members to note the list of appointments which are set out at item 2, and also ask if members have any other interests to declare? Nothing? Great. And can we confirm the minutes from our last meeting, which was held on the 13th of September 2017? Agreed. And can we note the completed and outstanding list of actions? Noted. Excellent. Thank you very much. And that brings us to today's main item, which is a discussion on the Mayor's role in promoting financial inclusion. And the key aim of this meeting is to assess what the Mayor, the financial services sector and the charitable sector can do to support smaller SMEs in London that have struggled to access affordable and appropriate financial services since the financial crisis. So can I welcome our guests? We have, starting at this end, Tony Greenham, who is Director of Economy, Enterprise and Manufacturing at the RSA. Welcome. We have Jennifer Tankard, who is the Chief Executive of Responsible Finance. We have Professor Richard Werner, who is Director of the Centre for Banking, Finance and Sustainable Development from the University of Southampton Business School. We have Natasha Jones, who is the UK Head of Corporate Communications, Funding Circle. We have Mike Conroy, who is the Executive Director for Corporate and Commercial Banking, UK Finance. And we have Faisel Rahman, who is the Managing Director of Fair Finance. Welcome to everybody. So, moving to our questions, I'd like to start with a question to Mike Conroy. This is looking first at supporting SMEs in the real economy. Mike, we hear a lot about the support being offered to innovative, scale-up SMEs with growth potential, but is there more that we could be doing for SMEs who just want to trade as they are?
I think, firstly, support for scale-ups and similar firms is not surprising when various reports, such as those put out by Deloitte and the Scale-Up Institute, do identify SMEs with growth potential. And have indicated that perhaps 70 to 225 billion could be generated by support to those sort of firms, and generating, as noted from my notes, 45 to 150,000 sort of new jobs. So I think the focus on scale-ups and growth is perhaps, I would say, a good thing. However, there are many businesses which I would describe as steady state. And if I can quote you some figures from the SME Finance Monitor, which of course your own report quotes quite extensively, there are 45% of SMEs that intend to stay the same size. So that's nearly half of them who have no particular growth aspirations. Perhaps the surprising statistic is that 16 to 22% of businesses with under 10 employees are actually seeking to grow by up to 20%. So there is a sort of a cadre of those looking for relatively high growth. But I would sort of caveat that slightly for the benefit of committee members, and saying that we do have a very high number of startups, particularly in London, so it would be quite natural for someone who's starting out for the first time to have more significant growth aspirations than what I've described as steady state. So I think it's absolutely important that the steady staters, provision is for them in terms of access to finance and indeed access to advice. In terms of their financial needs, I think broadly speaking, the market falls into two groups. which is a group known in the SME Finance Monitor as permanent non-borrowers, and these are people who represent about 46% of all SMEs and have absolutely no intention or desire to borrow at all. And they're a group that are usually established, stable, often have cash on deposits. And we were able to identify from the Finance Monitor that this particular group tend to have lower levels of planning, growth or innovation, and base their future investment plans on what they can afford. So that is a sort of picture, I would say, of that steady state. And that group has actually grown over time. It represented sort of 34% of SMEs in 2012, and I say has now risen to 46. So we have a number in that particular group. Another thing to sort of bring to your attention is that size is a key predictor of being a permanent non-borrower, but although not all permanent non-borrowers are small. But you have got 51% of the zero-employee SMEs, would meet that definition. And then, of course, the other group is the group that are happy to borrow. We know that 39% of SMEs are using external finance, and many of those are what I would describe as repeat borrowers. So they now have a track record, and it's much easier for those sort of businesses to obtain bank finance. And it's probably quite telling that something like 99% of requests for renewal for sort of overdraft and loan facilities with the major banks are approved. So once people have sort of got into the system, it's much easier for them to obtain finance. But overall, the market, whilst it unquestionably has recovered from the where we were in the terms of the financial crisis, what we're seeing across the overall market is demand for finance is quite subdued. We've only had sort of 4%, and that's a remarkably low number. 4% of SMEs have said they either applied for or renewed a facility in 12 months prior to being interviewed on the monitor, which is, as I say, quite remarkable. And 85% describe themselves as, or are identified in the report as happy non-seekers of finance. So they don't want to borrow, they have no desire to borrow. And possibly worrying is that 70% say that they would accept a slower rate of growth, rather than borrow to grow faster. So that gives you sort of a feel for the overall market. I think within those numbers, it's important to appreciate the distinctions between the market as a whole, where you'll see headline numbers saying that in round numbers, 80-85% of businesses do get the money they've applied for. As you will see, that those numbers are much lower for first-time applicants and much newer for people who don't have a track record, and that's why organisations such as Jennifer's play a very important role in this sort of landscape, because there are groups of customers which with the right sort of support and advice can be financed successfully, but it's outside of it, what is traditionally funded by the major banks. It's probably worth just finally commenting on and again from the monitor about the barriers to business that were referenced by the people who were interviewed, and the top one was legislation, regulation and red tape. Those who've been following SME surveys over many years would recognise those as often at the top of the tree. The current economic climate, which is probably not a surprise, and also political uncertainty and future government policy. So those are the top three of SME concerns, and actually 25% mentioned one or more of those factors as a barrier. The others on the list were cash flow and issues with late payments, which again is quite common. But surprisingly, only 4% rated availability of relevant advice as a major obstacle, and I found that a surprising statistic.
Why did you find that surprising? Sort of explicitly?
I thought there would be a greater appetite to take advice, and I know we'll sort of look at advice later on the session, and of course they do take advice on a number of sort of different issues, but I thought there would be a great appetite for sort of information and advice, particularly in a world which we have more regulation, more change, more opportunity. But it seems that obviously there's a group that feel. I imagine, obviously, the monitor doesn't sort of dive into those statistics, but it's either that they don't have the appetite for it, or they feel they're reasonably well served. But I'm sure we can explore that in in the sort of later session. And finally, there was 4% saw access to external finance as a major obstacle. And again, that's probably reflective of the relatively small numbers that are seeking to borrow. So I think, overall, in summary in this, I think, what the committee's identified is something that should rightly be explored, because there is a lot of there's a lot of support that's being created now, and a lot of focus on scale-up, start-ups, access to patient capital. But we shouldn't lose sight of the fact that within London, where we probably have, in round numbers, a million businesses, many which are very small sole traders, many who wouldn't even have sort of formal bank accounts. There's as many as probably 20% of SMEs would actually do their business banking through a personal account. It gives you an idea that how they're relatively micro, and a number would also not be running businesses full time. So many of these, maybe at the smaller end, are running businesses in a sort of a lifestyle way, whether it's complementing and supplementing, perhaps some form of paid employment. So it is important, and I think sometimes the data we have available in that sort of end of the community isn't as good as we might have on the broader SME community overall. But I think it is important that what I've described as steady-state business are properly supported, and if they do have a need for finance and advice, that they know where to get it from.
Thank you very much. I'm going to move on to Unmesh, who is going to pick up.
Thank you, Chair. My question is on access to finance. It's in three parts, and it's addressed to all of you. How effective have policy interventions been in the market for SME finance? 1. 2. What challenges remain? And 3, what evidence is there that some smaller businesses are financially excluded or underbanked? So, could start off with you, Faisel.
So I think in terms of kind of policy interventions over the last 10 years, the real focus in government in supporting, I guess, some of the alternative sector has been around guarantees, tax reliefs, but minimal actual direct government investment. The last time I seem to remember there being actual investment by the central government would have been things that would have probably paled in memory of things like the Phoenix Fund and the Regional Growth Fund, which have really focused in certain areas and others. I don't have a huge amount of experience on the kind of the policy environment, mainly because it's generally been quite difficult to access direct government support to support institutions that will provide alternative finance. I think in recent years the creation of the British Business Bank has done has changed significantly the availability of resources for organisations involved in this, so either directly with people like the peer-to-peer lenders or specifically with certain challenger banks. So in terms of that, I'll leave it for other people to talk about. They'll have a better view around that. But in terms of kind of understanding whether businesses are more or less financially excluded or underbanked, I do have a view. And I think, first of all, I'm not of the mind that there is an increase in financial exclusion. I actually find that most businesses are able to access finance and credit or some type of financing facility. What has changed rapidly is the cost that they pay for that. And into that market, it has gone from probably what you might have considered accessing overdrafts and credit cards to finance small businesses to quite complex, in some cases sophisticated invoice finance, merchant advances, and even forms of payday lending that exist within the small business lending market. And I think, as Mike has mentioned, many of these small businesses overlap their finances between personal and business and are often using a whole range of subprime lenders, which will now lend larger and larger amounts based predominantly on the individual as opposed to the business. And I think that market has increased exponentially. There's been a lot of data around how some of the alternative finance market has increased, talking about peer-to-peer and platforms, the billions that have been added into there. But a lot of that is property linked. If you look at the broader figures coming out of the Bank of England, which is looking at alternative finance in general, you see that the much bigger growth, in the region of 20 to 30 billion, has been around the growth of the subprime lending market into small businesses and individual. And I think that's the market that the real focus of interest should stay. And that's the market that I've seen grow exponentially in London and definitely around the country as well. The average customer coming to Fair Finance 5 years ago small business lending customer would probably have one or two facilities that might have included an overdraft and some type of merchant advance. Today, the average small business loans customer coming to us has around six different forms of credit, so they're not excluded, but some of those credit providers are charging anything from, once you've annualised the interest charge, from 70% up to 160%. What's quite hard is to unpick what that actual rate is. So I think this is a market that's growing, and I think it's growing in ways that are a little bit unusual, and I don't think it's an issue of banked or unbanked at all. In fact, I think most businesses have a banking service, whether that's personal or business. What is really, really changing is the cost of finance that they're getting access to, and that's been a big impact.
Could come to
so just on the policy interventions, we have seen a number over the last few years. So we've had Regional Growth Fund, which does target small businesses and businesses that the banks won't lend to. We've seen funding for lending and the Enterprise Finance Guarantee. However, on the two latter ones, there's no clear evidence about the degree to which they're serving the small element of the SME market as opposed to the element of the SME market, and there's a huge disparity between those. We've also seen regional funds, so most recently Northern Powerhouse Fund, Midlands Engine. But all that creates quite a patchwork of different funding elements, and so for a small business trying to navigate your way around all of that can be quite difficult, and to understand which of those is relevant for you without quite a lot of input and support. And the real advantage about Regional Growth Fund was that, as I said, it targeted both smaller, riskier businesses, but was also quite geographically focused. So it did target areas of the UK where access to finance was known to be a problem. In terms of financially excluded and underbanked smaller businesses, and what we see as a sector is that where we pick up on that is through banks declining access to finance to businesses for whatever reasons. But banks don't have to formally give people a letter, so it's hard to build up the evidence base around that. So under the Regional Growth Fund, in theory, we can only accept clients applying for loans if they've had a formal decline from a retail bank. But quite often the banks won't give those formal declines, so we have ways of getting around that. But as Faisel has said, we know anecdotally that a lot of small businesses are either, and Mike said, we know a lot of small businesses are either choosing not to pursue finance options, or they're resorting to personal methods, personal credit cards as well. But I think it's worth noting as well that there has been a big rise in sort of self-employment, and that's been very much a push, a sort of economic push, as people are pushed out of secure jobs. They're looking for alternative ways to have an income and to create their own employment. And I think what we see again anecdotally is a lot of people that are moving into the self-employment route because they've been made redundant, or they've had sort of fragile employment. So they're starting off setting up a business from potentially quite a fragile economic position themselves. So that in a way causes problems. And one sort of potential issue around that is that we know that many people who are self-employed, for example, don't set up pension schemes because they feel they can't afford to. So there's a real issue down the line of a pension time bomb amongst self-employed and micro-business owners.
Tony?
Thank you. And there's a lot to say on these two questions, but I'll pick out a couple of things that haven't been covered. On how effective policy interventions have been, I would say that, of course, the under-provision of SMA finance has been a lament since the Macmillan Committee in the 1930s in the UK. This is a long-standing problem that economists have agonised over. And I would say that, we'll come on to this later actually, but policy interventions have tended to focus around either regulation or, in some cases, some forms of subsidy to providers of community finance, which is welcome, but arguably hasn't gone far enough, I'm sure Jennifer would suggest. There's been very little, or too little, in my view, focus on the structure of the banking market. What kind of banks do we have? Because when you look at other major economies around the world, they're all characterised by having large shareholder global banks, which is great, they do large shareholder global bank things, but they also have a vibrant network of locally focused and often with a social mission banks. That's a sector we simply lack in this country. And although, without doubt, some of that role is performed by responsible finance providers and credit unions, in comparison with, say, the US, where there is much better support for responsible finance providers, we haven't done one or the other here. We've neither said to the big banks, you should, as part of your operating license, should make sure that you fund and really properly provide for the sectors you don't want to serve. We haven't quite gone that far as they have in the States. Neither have we said we must make sure that we have a diversity of different banks, some of which make it their business to make sure that they reach the SMEs that one of the banks don't want to reach. So I think policy interventions have not been effective enough because we haven't fully explored this structural point. If I can make one other point, which actually Jen has touched on. We always like to say at the RSA, because of our 29,000 fellows, many of them run their own businesses. And we like to make a distinction between SME, small and medium-sized enterprises, and SEM, self-employed and micro, so up to 10 employees. These are very, very different markets, and it is unhelpful to conflate the two and to try and look at macroeconomic statistics, because of course SME finance looks not too bad, but that's really driven by excellent provision to medium-sized companies, particularly if they're growing, okay provision to a lot of smaller providers, but I think when you get into the self-employed and micro end, there's still a lot of gaps. And on evidence on that, I would just say one thing about the financial exclusion underbanked. Again, to pick up what I think Faisel has said, is actually it's not so much lack of provision, it's whether there's appropriate provision, at reasonable rates and responsibly provided. I think that is more of an issue as to whether or not there is some form of finance you can get your hands on. Whether that's the right kind of finance, I think is actually the right question to ask.
Thank you very much. I'd like to back up actually what my fellow panelists or experts have been saying, and also give a few bits and pieces perhaps that haven't been mentioned yet. Tony is quite right to point out that the problems in the banking sector have been long recognised in the UK. You can actually go much further back. I always quote the Colwyn report of 1918. So it's 100 years ago, which said that, the problem is that the UK banking is dominated by the big five, clearing banks based in London that provide only short-term funding, but no long-term investment loans. And small firms find it hard to obtain funding from those banks. So, the problem has been recognised for a long time. And there's, in fact, every 3 to 5 years, there's another study, another committee, Treasury Select, or a committee, independent committee, whatever. And they always repeat the same things, but no realistic solution has been proposed, because any realistic solution would involve, as Tony mentioned, changing the structure of the banking system. So far, in the last 15 years, when there were expert panels, any attempt to include international comparisons were vigorously blocked, particularly comparisons with the US or Germany allegedly being, just irrelevant or too far away, whatever. So we have many examples, and in fact this is also an answer to the question concerning evidence. We have good studies analysing international economies, and the UK sticks out, and by not having local banks, community banks, not-for-profit banks. And as a result, we get final economic outcomes which are measurable and comparable. We can compare those with other countries that have those banks, and we see the class differences. So for instance, in Germany, 70% of banks measured by deposits is community banking, not-for-profit community banking. Measured by the number of banks, 80% are not-for-profit community banks. And this means that these are banks that are not extracting value for shareholders and dividends and bonuses, but all the money is locally reinvested. And of course, things like charges and dividends and bonuses either don't exist or very, very low in the first place. So of course it's quite clear that measures such as inequality will as a result look very different. The banking system is really at the heart of the economy, because essentially all transactions go through the banking system. This is true even when we have a vibrant non-bank financial sector, because all their money goes through the banking system again. Banks are special for various reasons, and therefore having the right type of banks that have the right structure, corporate governance structure, decision-making structure, incentive structure, will give you completely different outcomes, measurable outcomes. Another way of using evidence to shed light on this issue in the UK is to look at the link between the size of banks and the size of their lending and the size of their customers. And well, there's some charts and so on in the presentation. And if we have time, I can refer to that. But we found that looking at the US, which is interesting because it's the biggest banking system with 16,000 banks, and we have good data over long time periods, decades. Looking at this relationship, it was very clear that the large banks lend to large borrowers large amounts of money. The medium-sized banks do the medium-sized business and lend, medium-sized amounts of money. Who lends to small firms or even micro firms? It's small banks and micro banks. If you don't have them, you won't get this lending. And that remains a problem. So the problem is, and I think I agree again with what has been said, that there's still a lack of funding at reasonable market rates. Because you can always get some sort of funding, but at very unreasonable rates that will put particularly small firms at a disadvantage. So the measure rod has to be whether the interest or the cost, the overall cost of borrowing, puts the borrower at a disadvantage compared to larger firms. And by that measure, we still have a huge problem in the UK because a lot of the non-bank routes that have been developed still mean a lot of high costs, much higher costs than if you were a larger firm. So what we essentially need is a change to the banking structure, which can be quite easily done. It's not complex, it's not difficult, it doesn't have to take long, by introducing those banks that, by the empirical record in many countries, are able to deliver the outcomes that we want delivered, namely supply of sufficient funding at reasonable rates to small firms, the right service for them that looks after their interests and is not trying to take advantage, and of course sufficient diffusion of such banking services so that local small firms, micro businesses are able to use them. And that can be done, and hopefully later we have time to talk about the concrete policies and steps to do that.
Chair, I'm conscious of the time, but I don't know if you have any thoughts, Natasha and Mike.
Yeah, thanks so much for having us along today. Just to give you a quick overview of how Funding Circle works, we're an online lending platform, so we're a non-bank solution. And we basically have created a platform where any investor, big or small, can lend directly to small businesses. So we're focused exclusively on small businesses. And the reason why the business was set up in 2010, and the reason why I take you through this now is because it's quite a young business, was because our founders looked at the small business lending market in the UK, and it was the same problem as 1918, which is, the major banks were doing 90% of the lending, and what they wanted to create was the infrastructure where, like I say, any investor could lend to small businesses. If you look at the as you kind of go up the size of business, you look at the mid part of the market and the larger part of the business market, there's many ways for you to access finance, but at the small end, there really, back in 2010, really, or 2008, sorry, there really was only one way, and that was through your high street bank. So what we wanted to create was this kind of like a stock exchange, I suppose, where many different investors would lend. And today we've got 70,000 people lending through the platform, retail investors. The UK government lends through the British Business Bank programme, which I'll talk about more in a moment. Local authorities, a university, and then a range of financial institutions, so pension funds, but also more recently an insurance fund, Aegon, committed a large amount over the summer to UK small businesses. And we've helped about 27,000 businesses across the UK. 2.6 billion has been lent through the platform, and in London specifically, about £500 million has been lent to nearly 6,000 businesses in the capital. The business has kind of come quite a long way in the last 7 years, and we did some research last year that found that an estimated 70,000 new jobs have been created as a result of this lending and borrowing. But going on to your question around initiatives that the government have set up, in our response we've really identified two very significant interventions by the government in the small business lending market. And the first was, you've already mentioned, Jennifer, the Funding for Lending scheme. And obviously that scheme saw a lot of success on the consumer lending side, but saw less success on the small business lending side. I think it's fair to say, if you look at the outstanding stock of loans to small businesses since the financial crisis, has actually fallen by about 20%. We think that that's a result of net lending, poor net lending. So that's essentially new money to the economy, and it's the measure that the Bank of England use when they're looking at stimulus to the real economy. So it's total amounts of lending minus repayments. And when you compare the net lending of the banks in 2017 so far with Funding Circle, let me just get the exact numbers. So in the year to date, 425 million has been lent by 30 of the UK banks to small businesses on a net basis, whilst lending through Funding Circle has been 377 million on a net basis. So you're beginning to see, I think, lending platforms like ourselves really compete with the entire banking system on a net basis. So I think that kind of touched on the Funding for Lending scheme. The second one that we identified was the British Business Bank the lending that they've been doing. So they were set up to facilitate direct lending, particularly to stimulate alternatives to finance. And they have now committed 100 million through the platform, 20 million initially through another scheme, which then got rolled into the British Business Bank programme. Most recently, they committed 40 million at the beginning of this year. And to date, they've helped about 15,000 businesses through the platform and earned about £5 million on behalf of the taxpayer in return. So like I mentioned, investors earn a return by lending to these businesses.
What are the interest rates for the end lender? If I may just interject that relevant question.
So the average return that an investor makes per year is 6.5%. And that's
from the borrower side. What are they paying?
Borrower side, the average cost of the loan is between 10 and 12%.
Okay, thank you.
Finally, Mike, have you got anything to add to what's already been said?
Absolutely. I think there's a couple of points to sort of pick up on. One is that I hear what's been said, of course, about the concentration of banking in the UK, which is actually not that uncommon to many other parts of the world. But more relevantly, we have just had a Competition and Markets Authority inquiry into the banking sector, for which the CMA has introduced a number of remedies to make the market more competitive. So it is worth looking at that evidence base if you want to see their view of competition in the UK. The other way I think of sort of looking at it to answer the first question about sort of interventions and particularly on finance gaps is that I think it's probably helpful to make a distinction between business owners that have, if you like, a sort of a viable business plan and need funding but are denied credit by existing providers and treat that as one finance gap. And that's one that the British Business Bank looked at, and your own report makes reference to that. And it cites a figure of around about 4 billion a year from a market of about 80 billion, to give you a feel for that. So if you scale that back to the London economy, that suggests a figure of about 0.8 billion a year in terms of that particular gap. And that is the gap that the British Business Bank, as I've said, identified, and therefore has put a number of interventions in place to seek to address it. So that includes some that we've heard about, which is the Enterprise Finance Guarantee, and in particular startup loans. Startup loans, I think, has been these days a major provider of funding to new starts. And of course, the business banks also made investments in equity schemes, alternative sources of finance. And it is worth mentioning the other recent intervention from the Treasury, which was the introduction of a platform referral scheme. And that means that if any small business, and that's literally anyone from 25 million down, is declined by a major bank, they are obliged by regulation to make a referral to government-designated platforms. And these are essentially online, I'll describe them as online credit brokers. And they will put the business in touch with alternative providers in the marketplace. And that's been running now for about 9 months. Now, I think what's sort of interesting with regard to that particular scheme is that first of all, only £4 million has been provided in 9 months. That's much as a typical bank might lend in an afternoon. So that gives you some idea of that we have an intervention there that you think perhaps might not be working as well as you might imagine. But there are reasons for that. But I think an area where it perhaps could work better is that it doesn't provide access to advice and support. So what you're finding is if someone's not able to get over the line for a piece of bank lending,
moving on to advice and support.
We'll do later on.
In a bit.
So I think in my view, I think the British Business Bank interventions have been very positive. I think the other group where the gap exists is for those who essentially don't have viable business plans and how they can be supported to get to the point where they can do, and maybe we can pick that up under support and advice.
Thank you.
Thank you, Chair.
Thank you much. Tony, I think you were going to come in with a couple of questions for Faisel.
Yes, I read your report where you described this area as the twilight zone. One thing which has struck me reading your report, before I get on to the question which you know about, is how is it you charge individuals typically 136% over 6 months for a loan, but a business only 5% a month? Is it the difference between a secured and unsecured loan?
I think it's a mixture of... So first of all of our loans are unsecured, whether they're business or personal.
I missed that. Are you saying they're all unsecured?
They're all unsecured, whether they're business or personal. Yeah. That's the gap in the market that we wanted to address because we're focused on dealing with what we think is the biggest problem. Effectively, people without any security or collateral struggle to access credit. That's the kind of the underlying principle. The reason for the price differential is partly size. So we probably do a similar amount of work. Well, sorry, no, we don't do a similar amount of work. We do quite a lot of work to make a decision as to whether we can lend to an individual. And some of the costs involved in that, they don't really change whether the loan is small or big. So running a credit search for an individual is not that different from running a credit search for a business. The business might borrow more, so as a portion, the cost might be a lot lower, but it's still a cost that we have to bear. So for the consumer loans, we are averaging around £500 and we charge a 99% interest rate on a declining balance. The uptick is because of the time period and an admin fee. It's still 1/10 of our closest competitor, but the business lending can be around £20,000 and a lot bigger. So as a proportion, the cost is much lower, so we're able to pass on that cost reduction to customers.
Yes, it's a little less impenetrable than it was when I first started it. But so far as the questions which I'm thinking to ask you, you provide, as I understand it, Fair Finance provides a sort of map saying where loans are given right across London. Are you able to say, well, you presumably must be because you provide this data, where the demand is the greatest? As a layman looking at this matter, I would think that the part of London which I represent, which is South West London, is much less likely to come to you, shall we say, than North East London. Would that be fair?
Yeah, we make very few loans in South West London, that's for sure. The disclosure that we do, maybe if I take a step back, is
yes.
When I launched Fair Finance in 2005, we talked about financial exclusion in London, and at the time, the conversation wasn't about a lack of credit, it was the provision of too much credit. People didn't believe it was such a big issue and such a big problem. And in many ways, one of the challenges we had was to convince people that there were not just pockets, but areas of London and the surrounding southeast where people would struggle to access credit. And sometimes they're hidden because they might be living cheek by jowl to very rich wards, districts or areas. London has that makeup. What we wanted to do was to try and get an evidence base that there was exclusion existing in the UK, specifically in London. And we encouraged and asked many organisations to publish their data over time. And we were told that it was just a very difficult thing to do, and nobody should be able to do it, nobody could do it. So in a way, the map that you see there is our attempt at showing how easy it is to do this. It cost us a couple of £1,000, and the map effectively details all of the lending that we make, not all of the lending that's happening in London, it's just the lending that we make. And we target our businesses focusing on people who are unable to access mainstream credit. The reason for creating the report was twofold. One, firstly, to prove it's possible, and then secondly, to help direct better policy so that people could actively see where financial exclusion was an issue in the UK. When we first produced that map, it was very, very localised. In fact, you could see it in our branch. It was in our first branch in Tower Hamlets. As the branches covered a bigger and bigger area, the size of the map increased until we moved it online. You can zoom in, if you have a look at this map online, down to the ward level. So we even look at it down to a ward. And what we wanted to show is that we expect most of our customers to probably be in the areas that most people define as having issues with accessing credit. So women, minorities, people without assets, people with some level of lower income levels. And so we disclose all of that information online. And what you see disproportionately by looking at that map online on Fair Finance's website is that those are our customers. So we reinforce the kind of the expectation that these are the people who will be excluded by being able to confirm that actually, yes, these are the people that we're seeing, and they are the ones who are disproportionately struggling to access finance. We use that map as a campaigning tool to encourage others to do so. I think if all banks, lenders...
Have you encouraged anyone else to do such a thing?
I would argue that a little bit of that map has been instrumental in supporting some of the government policy to encourage banks to disclose their lending in some of the most deprived wards in the United Kingdom. So the Bank of England compiles that data and publishes that data. They don't do it anywhere near the granularity that we think is important, because we think exclusion is not just geographic, it's sometimes based on gender, ethnicity, a whole series of different factors. And those aren't done.
Didn't Booth do exactly the same kind of thing more than 100 years ago?
With the poverty map?
Yes.
Yeah, I don't know if he was looking at financial inclusion, but he was definitely looking at income inequality. So yeah, I would be, people have looked at this. And in a way, the inspiration for this is a little bit around mapping data, but it's also an inspiration from the US, where in America, banks are mandated by law to publicly disclose the communities that they're lending into. And the banks are effectively assessed annually as to whether they are meeting their community commitments. And that community commitment is a factor in determining whether that bank is allowed to purchase another bank, close a branch, or do something else. And you can get data on whether they are charging white people or Hispanics or African Americans more or less than each other, and whether they're committing finances to those communities. So in a way, what this map is a way of showing we could do this in the UK. And we are just giving an example of how easy it is. We would expect others to copy it. And if you could get more people doing it, I think you could have some useful baseline data on where exclusion exists in the UK.
Okay, thank you. I'm afraid I have to go now. Could you take the next question?
Yes, of course. And Fiona wanted to come in.
I did. Thank you. And I noticed, and you've mentioned the sort of gender balance of your loans, and obviously the map and the charts on page 6 indicate that you lend more to women than to men. That's for personal finance?
That's in personal finance, for sure.
Do you have a similar breakdown in terms of business lending as well?
Yeah, you can have a look at it in more detail online, but probably our loans are split 40-60.
So it's a similar sort of model?
But flipped. So I think we lend 60% to men and 40% to women.
What with business loans?
Yeah.
Okay.
Which is very different from what we understand to be the national numbers.
Because there's particular issues with access to business loans for women as well, isn't there? So
that's as we've understood it.
Yeah. Okay. That's interesting. And in terms of other banks, how does that compare to other banks? How do your lending rates in terms of gender?
We'd love the banks to disclose that data.
We'd love so the main issue is that nobody else...
If every lending institution in the country was to disclose whether they lend their breakdown between men and women, I think you'd have some interesting conversations. But right now, you can't get that data properly. Not
So,
without
and
individual
do you
research.
also publish who you don't lend to as well? Is that something else that you'd want banks to, that you'd want the data on who doesn't get loans as well as who does get loans? Because surely what the breakdowns in terms of ethnicity and gender for people who get turned down is actually, from a financial inclusion point of view, as interesting as the people who do get them.
I mean, I think us giving that data is probably less useful than others. But
Yeah,
I mean,
no,
as
absolutely.
As Mike was saying,
yeah.
a lot of banks are now mandated to put some of these individuals or the businesses that they're not lending to onto various platforms.
Yeah, I think we're coming on to that shortly. Thank you. Okay, sorry.
There's one...
For clarification, Tony's question on the interest, this is, we didn't have the benefit of, or at least I didn't, looking at this report. So what is your average per annum interest that a borrower,
I'm just
individual borrower,
slightly worried
just so we
about
know
the
we're comparing like with like.
So we'll make sure you have that data before the end. Just one further question that Tony was due to have asked you, Faisal, which is what evidence is there that some SMEs are turning to the subprime market for finance, and should SME lending be better regulated?
I think just the quick answer is to say yes. Yes, and significantly, and I agree there should be more. Mike's also right to point out the CMA inquiry into this market, which has really exposed the lack of data, transparency being an absolutely massive area. So to give you an example, there is no standard. So as you probably know, business lending is generally unregulated in the United Kingdom, which means that there is no standard model for describing interest rates. Unlike consumer lending, where you have to tell people what the total cost of credit is, whether there are admin fees rolled in, there are examples in the business lending world where that just doesn't exist. You can't see it, to the point where you only discover it after you've made the loan. Just linked to that, just very briefly, is that this also covers, the CMA covers better disclosure on a kind of an APR type lending for loans that are under 25k, but this also covers some of these self-employed clients who are also within this kind of broad brush of regulations. And it should just be pointed out that self-employed individuals are lending to self-employed people is regulated under the Consumer Credit Act. So it has a very high level of disclosure. And because of that, what we've seen is a massive exodus of lenders to self-employed clients. Lots of the online platforms are not lending to those individuals. The levels of disclosure, the transparency required, mean that many of them are moved into focusing on small businesses. So I think the area of thinking about whether the area has enough transparency and regulation is just one that is a yes, but you need to look at it quite carefully, because there could be just unintended consequences, such as people exiting the market and moving out. But it does expose that this is a big area.
Thank you. I've got two interventions from over here. Briefly, Jennifer.
Just very quickly, so I just wanted to reinforce that point about transparency. So as a responsible finance provider, our members have to be transparent about the costs of the credit they're providing. But what you'll quite often find is if people are comparing on an APR basis, that some other lenders, non-responsible lenders, will have a lowish APR, but there'll be a lot of hidden fees and charges attached to that. So the overall cost of credit is much, much higher. But it's hard at the start of taking out that agreement to work that out. So having more regulation to force that transparency would be really welcomed.
Great, and Tony.
And all I wanted to say was I was a member of a project called Banking Futures, which was civil society organisations, investors, regulators, and not all, but most of the main high street banks. And this looked at this issue of regulation of SME finance quite closely. So I don't want to go through the, actually Faisel's mentioned quite a lot of the hot topics, but if I could just commend that report, which I know Matt has seen because he's referred to it in here, and also the work of the APPG on fair business banking, which is pursuing this topic. So I would suggest the committee could very usefully lean on the work that's already been done via those initiatives to answer your question.
Thank you, that's really, really helpful. Susan, can I bring you in now on access to advice and support?
Yes, thank you. What kind of advice and support do most SMEs look for, and how can that advice and support be improved? And does it differ from the SEMs? I completely agree with Tony, there's such a difference between those two groups, and yet they seem to be lumped together so often. And particularly for Mike, Jennifer and Faisel.
Shall I kick off? So most of our members, most of our business lenders do provide wraparound services. And as I said, we deal with the small micro business end. So what we would see, what our members routinely would be giving advice around is very basic stuff. So how to draft a business plan, how to manage budgets, how to access finance. So it's very, very specific around those sort of basic business management skills. There's been a lot of emphasis through some government programmes like startup loans on advice for startup loans. But what you find is that tails off, and in fact where a lot of businesses fail is at the 2 to 3 year, once they've been going for 2 to 3 years, and there tends to be a lack of provision at that end. But overall, the advice market is very, very fragmented. So again, small businesses are expected to work out what their own problems are, then navigate around to find the advice they need. And there are real quality issues with some of that. So I know a second question was about mentoring, and we have seen that business mentoring can work really, really well, but it's really dependent on the quality of that mentoring and finding the right people. So just assuming because somebody's worked in a big corporate that they can advise a small business is just, maybe they could give some help, but there's a real disconnect between the understanding and the experience. And what we find a bit is that if small businesses have a bad experience with business advice, they'll just think, I'm better off just getting on with it myself. So they then don't feel incentivised to tap into what advice there is, even if they can find that at the time that they need it, which can be quite difficult if you're sort of busy trying to get your business off the ground.
Which, Mike or Faisal?
I'll happily go next. My experience both as working in branch networks and speaking to sort of many businesses is that, as Jennifer sort of alluded to, advice is often sought by those who are looking to start up. That seems to be those who are making that step for the first time. And bear in mind, what we heard earlier about sometimes people coming out of employment and into a world of self-employment. There's a lot that people then have to take on responsibility for, and I think in many cases there's advice sought there. For those that are established, I found that people are interested in finding new customers and looking how to sort of build the customer base and generate more revenue that way. You do get those who want to understand more about their financing options. Again, I think we've heard this afternoon, there are many businesses who still don't see much beyond an overdraft or a loan, when of course there are many more alternatives available these days. And then ultimately they'll seek help with tax and regulation. And I suppose finally, there are those who will need help with debt advice, and I think those are, that probably encapsulates. I'm sure there's many more, but that, in my experience, is often what they're sort of looking for. I think in terms of where they get it from, I think since the rundown and closure of publicly funded national business support in the area of sort of RDAs and business link, it feels to me as if the structure of business support and advice is gone through a period of change and arguably turmoil in some cases. And I think we would perhaps just need to be cautious of, given all that change, is whether or not you want to make even more change to a landscape which is already difficult for people to navigate. I think on the banking side, I think if you'd undertaken surveys 20 years ago and you would have seen accountants and banks being places where people would quite naturally have gone for business advice. In today's world, whilst I think the accountants are still very highly regarded in terms of business advice, for various reasons, it's less commonplace in sort of high street branches. And I think, in some ways, business banks are cautious about giving advice because they feel that they see risks attached to giving business advice, but are very happy to give out information. But I think that's, just really giving you a descriptor of the landscape. But there are a lot of things that banks do in terms of information. Most will provide guidance on preparing sort of business plans and applications, typically online. Obviously the referral scheme that's sort of mentioned. But I did want to say a little bit, if I'm not getting out of turn, on mentoring. And I noticed in your the paper we submitted for today, there was a comment made that there was no evidence on how mentoring, how effective it was. And possibly the fault lies with the banking industry for not publicising it more extensively. But a report was done into a mentoring programme that was established, which I think again is referenced in the report as Mentors for Me, but it's actually Mentors Me. But it was something that was established around about 2011 from memory. But an evaluation was done of that in 2015. And if I can just quote a number of sort of headlines, stats to you, is that 65% of businesses that had those mentors said there was a positive effect on international expansion, 62% positive effect on turnover, 55% positive effect on profit. 62% positive impact on increasing product markets and business services, 67% increase in productivity. So I think and I absolutely take Jennifer's point about quality and horses for courses. I think the same criticism would have been made at Business Link in terms of the you were perhaps it rather depended who you got, but but I think overall, certainly based on the evidence we've seen, that people's experience of mentoring has been very positive. Do I think more could be done with it? I do. I think I think a lot of mentoring these days, but I obviously stand to be corrected, tends to be at the sort of micro end of the market, and I wonder if we couldn't do more to bring business people who've been there and done it, real businesses, to try and provide some of their expertise to others who are facing similar problems and issues, and just make more of that sort of networking side. But that's my sort of
I agree with that, definitely, because all businesses are different with completely different issues and problems. Yeah. So Faisel, finally, do you if you've got anything different to add, do you think the banks are giving more information as opposed to advice? And if people come to you, what sort, is it just financial advice, or are so many of them completely clueless is harsh, but do you know what I mean, in VAT thresholds and stuff like that? Do they ask you for that sort of advice?
Sure. I think kind of touching on what Mike said around, I think there's been a general fear in the lending industry to give anything that might be construed as advice, right, telling people what to do. And I think because of the lack of transparency in the market, people have been demanding a lot of information, because it's very difficult to figure out what the right choices are that's available. And so lots of the focus has been around how do you get people more information as quickly and as easily as possible. And I think there's a massive space for that, because the market is complicated and people do need advice. They do need information. I also get the feeling that there's a different type of work, which is advice, right? There are skills and technical abilities that are required to do things, which I have to say, in my experience of working in London and in this field for about 20 years now, I generally find pretty poor, actually. There isn't really a coordinated way of understanding how to identify those skills or where to get those types of skills and support from. And then added to that, there's, as kind of discussed, this kind of process of mentoring, which I think is not that useful for people starting up their businesses, but amazingly useful for people growing larger businesses because they have the time and capacity. So I think there are lots of different things that need to be provided. People come to us generally confused, looking for information. However, most of them really understand their business, and there isn't really much I can tell them about how to make their business better, because they know it. What they really need is a bit of time and reprieve and support, and often the only tool that we've got is about helping them manage some of the creditors, reorganising some of their finances, just providing some useful practical support. So in general, like I said, I have a pretty poor view of advice and support, because it's generally provided badly. So if that could be provided better, I could see some advantage. One of the biggest failures around that, though, I think we have this belief that most of it needs to be provided by a person who comes to talk to you, and I think one of the things that small businesses struggle with is time. Yes, that's right. They just don't have the time to come and spend going to a pointless workshop or sitting in a room talking to someone. What they really want is probably a bit of support to identify the problem, and then to go and find how they can fix it. And they're pretty smart people. They know how to apply it, and I think there's been a massive failure of transitioning much of what we'd considered advice work face-to-face into online processes, different types of innovations that could be used to help people understand this problem better. And I think that's a big area of work that hasn't been focused on.
Okay, thank you. I think Richard's turning Richard. Yeah.
I'm a chartered accountant, and at one stage I ran a high street practice for a couple of years as an interim principal. And Mike's point about that being one of the traditional sources of advice is true. I would just note that, and I don't know about the London market specifically, but the traditional small high street firm, one or two, maybe two partners, has been, under threat from the volume of changes in regulation that have swamped, the accountancy industry. So I think that, in addition, as a source of advice, might be drying up. But I want to amplify something that Faisel said, because there's a difference between advice about somebody's business and how to make it better. I think the real advice that's required is to help business people to translate their business into financial terms, particularly cash flow forecasts and other financial information that makes them investable, that allows banks to then lend to them, because the information has been marshalled in a sensible and robust way in terms of the numbers, which is obviously one of the things that accountants used to do and bank managers used to be able to help with. I think that's the gap that isn't fully provided for, which is different from trying to advise someone on how to run their business better. And I take the point that I think mentoring probably is, perhaps it works better for growth businesses than for startups. You've got a new business idea that. Anyway, that's just what I wanted to add on that.
There is a solution to this problem. If you look at Germany, you've got 1,500 community banks, and they are the biggest single type of institution that is running apprenticeships. So each community bank, and of course London would probably have around 300 of them distributed across the boroughs, with several in each borough of London. They would train, 3-year apprenticeship schemes, young people for age 15, 16 for 3 years, and they would be trained in banking, all aspects of banking, down to international finance, FX, all sorts of things. And they would train maybe 3 to 4 times as many people as they need themselves. So what happens is they will be hired by the local businesses after that, and they work in the finance department, and they have the skills to do what Tony mentioned, produce the right financial statements. They know how the bank works, they know what the bank needs, and it's like having your own young little banker in your small company, but at local, very very reasonable rates. And so this is how the training, the skills, the technical know-how that businesses need to formulate their business in financial terms and appeal to funding sources, customers, tax authorities even, is delivered. So it's possible with a network of community banks. Whereas of course in the UK the situation is we don't have those banks, and the big banks have no time for small firms. It's understandable, because for big banks it only makes sense to deal with big customers. That's why Project Merlin and other schemes that have been tried to untwist the big banks to lend to small firms are doomed. It's never going to happen. And of course they have cut down on branches, but especially on staffing. The business banking staff have been cut down rapidly across the nation, and so very often as a small firm you need to make an appointment, which will be several weeks in the future, somebody coming through in various intervals, and that will be bad enough. But of course there's worse if you scratch under the surface. As the Tomlinson report showed, there are also enough instances where the big banks on purpose want to bankrupt small firms because they see some attractive assets they can seize as the only creditor or high-ranking creditor. Predatory lending is a way of getting your hands on those assets by asset stripping the bank. This is well documented.
Yes, stop.
So there's a choice.
Too depressing. Yes, we must be
banks.
looking at the positive. But thank you. Yes, I appreciate what you're saying.
Right, are you
And
you're
that's-
done? I will bring in Fiona, who is going to be moving us on to look at peer-to-peer lending and crowdfunding.
Thank you. And my questions primarily to Natasha. You did outline some of the points around the model, but is there anything else you'd like to add about what sets peer-to-peer lenders apart from mainstream banking services?
Yeah, sure. So I think we could probably categorise it into 4 areas, but ultimately at top line we think we're delivering a fundamentally better service to small businesses. Firstly, around speed. So businesses can apply online in 10 minutes. They receive a decision within 24 hours on average, and the funds in their account within a few days, but certainly within a week. And that when you compare that to traditional players in the market, historically that's taken about 3 months. So we've significantly reduced the amount of time it takes to apply and receive the funds. Secondly is around our use of technology and data. So we combine big data with our proprietary risk models and our proprietary technology now as well, again to streamline that process right down. But we still use the same credit checks that banks do. It's just we feel that our technology and our approach to data has significantly reduced the time. Third is around flexibility. So, as you mentioned, Richard, time is an issue for small business owners, and 50% of our applications actually come outside of working hours because we are online. So we think that there's a real benefit to the online model in terms of flexibility. And the fourth is around transparency. So we have no hidden costs, no early repayment fees. What you see is what you get, and we publish all of that data online so that our investors can see who they've lent to as well.
Thank you. And in our notes it mentions something about one of the attractive points being about businesses struggling to get a meeting with the bank. Is that because the banks aren't interested in lending to them, so they don't even see them in the first place? Or is it because banks just don't have meetings anymore?
Well, I think probably Mike would give the best answer to that in your experience from the banking perspective. But from our perspective, we actually work with 2 high street banks, with Santander and RBS NatWest, and the reason for that being that many of the conversations about applying for finance happen face to face. So if you look at the number of businesses that actually get round to applying for a traditional bank loan, there's quite a significant drop off, I would say, between the conversations that you have in a branch with your relationship manager, and then the number that actually go through to a formal application, and then the number that actually get right down to a formal decline letter is around 12%, according to some Oliver Wyman research that was done a few years ago. So actually the kind of high quality referrals, and maybe I'll just take a step back. Basically we work with both RBS and Santander, where if they cannot help the business who is looking for finance, they actually refer that customer to us, and we then see if we can help the business with the loan. And actually, I think, going back to your question, is it just a case of people not actually putting applications in? I think there is probably quite a large group of people who, have those face-to-face conversations. It's quite informal, and it's at that point, if the relationship manager doesn't feel like they can help the business, they then would refer to us if those relationships exist.
Okay.
Do you think that's right?
Yeah, I think that's right, Natasha, and I absolutely agree with Natasha's first point, which is the attraction of peer-to-peer lending, which has been a bit of a wake-up call, I would suggest, to some providers, is that it has scored very highly on things like speed and convenience, and as a result of that, high street lenders in some cases have looked at these models and think, well, how can we partner with or white label or do some other things to help the business community in that way, and obviously are very much trying to up their own games and developing solutions to recognising that speed and convenience point, and indeed it is that ever increasing use of sort of digital and online that's mean you're getting far less footfall now, business customers in branches, than you would have seen sort of 20 years ago. I think again on the sort of referral side, is that what Natasha says is true, is that there's in the business world it's very rarely as simple as I can complete an application form and hand it to someone to assess. It's often the makings of an idea which they run past someone, and these things try to get shaped, and that's the way it works. But
thank you.
Yeah, but overall, great addition to the landscape and having peer-to-peer lenders in it.
Thank you. And going back to Natasha, do you think that peer-to-peer finance can meet the demand for investment from financially excluded SMEs, or will the returns to investors too small?
Yeah, well, it's a very good question. So the same research that I mentioned earlier on found that 80% of the businesses that we help, or our customers, believe that they would be able to access finance elsewhere, whether that's through the banks or other means, which leaves a kind of final fifth of businesses that are our customers that don't believe that they would have been able to access finance elsewhere. So we do think that we are expanding the market, and particularly around businesses where they are asset light. So for example, a marketing or a professional services firm might not have many assets to secure a loan against, but are perfectly profitable, are able to take, say, £100,000 loan and hire 2 extra people, and they can do that through us on an unsecured basis with a personal guarantee. So we do think we are expanding the market, and specifically on sole traders, because I know that you were interested in that. 140 million has been lent through the platform to 1,800 UK sole traders, and in London that money has gone to 200 London-based sole traders.
Yeah. One of the issues I was quite interested in is the figures around the numbers who are of people who borrow through you who are in real estate, which is sort of potentially quite a long way away from the financially excluded sort of groups that we're particularly interested in looking at. What is it about? Why is it particularly real estate? Is that because of who it's marketed at, or is that because the people investing are keen to sort of get into the sort of real estate and there's potential fast profit?
Yeah, so I did see those numbers in the pack that you sent around, but what I can say about Funding Circle is that we're representative of all sectors, and we pretty much follow the national spread in terms of sector. So that would be the same for all lenders then, that there'd be comparatively high levels of lending to people working in real estate? Yeah, I wouldn't want to necessarily speak on their behalf, but I know that there are platforms in this space who are purely dedicated to property finance. And in fact, just to give you a little bit of colour, we actually, a couple of 3-4 years ago, we launched a specific team to look at property development finance, so for small house builders. So we did actually do some of that lending ourselves.
Right, okay.
We decided earlier this year that we were going to focus on our core product, which is the unsecured small business loan, and so we're actually winding that part of our book down. So we have done some property development finance, but I think the numbers that you've seen are perhaps more related to the platforms that are specifically doing property finance.
Okay, that's helpful, thank you. And final question on this particular point, because I'm very aware of time.
We've also got Jennifer and Faisel wanted to come in. Was it briefly on the point that's just been made? Both of you.
One piece of, because obviously you're collecting information. There's a regular report. There's a report that's come out from the from Cambridge Judge Institute alongside Nesta, which has been looking at apparently 95% of the peer-to-peer lending market and the alternative finance, which gives quite a good breakdown of where the funding is, and it lists, having looked at 95% of the market, that there's 1.49 billion being lent to businesses, of which 609 million, so just under half, is being lent to real estate. And I won't quote the details of the report, but happy to share the figures, but you can get some more information. And I think it's, as you say, specific funds, specific peer-to-peer platforms, and actually it's actually quite a big business for many people.
Thank you.
And I just wanted to briefly say as well, just to reinforce Natasha's point, we really welcome peer-to-peer lenders and that they have expanded the range of financing options available. But for our members, we don't particularly see P2Ps as competition, because most of the businesses that come to us are higher risk and less banked. So in a sense, you know, they're sort of the next step up after people have come to us. So it's complementary rather than competitive.
Okay, so that ties into my next question, is what happens when SMEs referred by banks are rejected by peer-to-peer lenders? Do they go to Jennifer then?
So we, whenever a business doesn't meet our minimum criteria or doesn't go through the full credit assessment process, we will try to help all of them by referring them to perhaps equity crowdfunding platforms. There's a couple of really good platforms in that space. Also, perhaps Jennifer's organisation, we might talk to brokers and kind of put them in touch with someone who would be able to help them with a range of options. So, you know, whilst not every business will pass the credit assessment process and go through to be listed on the platform for investors to lend to, we do try to offer some options at the end.
I think you might have answered the next question I've got, which is what are the main reasons for loan applications being rejected? Is it simply the credit ratings generally?
Yeah, so you have to have been trading for 2 years as the minimum. So we're really the next stage of growth. We're not the startups. And you typically have a turnover of around £50,000. So mostly businesses are looking to hire an extra person, like I said, move to a larger premises, buy a new piece of machinery. And so if they don't fit into that, then we will try to signpost them in the direction of other providers that might be able to help.
And is the information recorded about people who are rejected by peer-to-peer lenders? And is it shared? Where's the transparency in this? Is it recorded and shared?
So that's not actually something that we publicly release at the moment. Not necessarily because we're embarrassed by the numbers, but we are relatively new and young in the market, and we don't really want to turn businesses off from applying. So, you know, just give us a go. We'll see if we can help, and if not, then we will try to signpost to other relevant providers.
Okay, thank you.
I'm now going to bring in Andrew to pick up on responsible finance, and these questions are primarily for Jennifer and Faisel.
Right, sort of following on from what's just been said, so how do you then fit into the picture in supporting the SMEs that we've been talking about, the ones that can't get money anywhere else?
So all our members are broadly not-for-profits, and most of them have been running for 10 years, maybe longer than that. And they are geographically located, so they serve local geographic markets primarily. And they provide business financing from really small loans up to about 150,000, but that tends to be the top of where they're financing at. They often run government programmes, so have been very involved in the startup loans programmes, Regional Growth Fund, and I mentioned earlier some of the more regional funds such as Northern Powerhouse. Our members provide holistic but realistic services. So we provide the wraparound support. Most of our members will provide business planning, budget management, and those type of services so that people are getting not just credit, but the ability to manage that credit. But as responsible finance providers, we are clear that we don't give credit to everybody who walks in the door. We have to do risk assessment. A lot of our funding does come through government programmes, so that has to be managed effectively. But we tend to use as a sector, we tend to use slightly different forms of risk assessment. So we don't do historic credit analysis. We tend to look at the business proposition and the viability of that business proposition. So we look at the future rather than at the past in order to assess that risk. As Faisel mentioned earlier, we do a lot of unsecured lending. And I think in somewhere like London, that's particularly important given how many people don't now have houses or properties that they can use as secure loans. So, you know, if you've got a segment, a big chunk of your population that are in private rented, that becomes a real issue about how do those people access finance if most of the finance on offer is secured. And Faisal might want to talk a bit more about that. Because our members still largely offer quite old-fashioned relationship management, not only, a lot of our members are moving to online lending as well. But the advantage of having relationship management type approaches is we can do quick intervention. So if we know that a business is missing a payment or there seem to be problems, we can quickly have that personal contact with them and have an early engagement about where there are problems, and then talk very early on about restructuring that credit so we're not leaving things too far down the line to get people onto an even keel. So that's important, as well as being geographically located. We know that there are specific market segments that tend not to be very well served by other lenders. So things like creative industries, tourism industries, agriculture. So anything that's very seasonal, where it's very difficult for the bigger sort of players to do effective risk management, tend to be areas where we tend to do a lot more activity. So I think in our written evidence we did set out the impact we have. We're quite transparent about that. We do annual surveys that show who we're lending to, where those markets are, and how much reach we're having, and the economic impact of that as well, which we can calculate in terms of getting finance into the market.
So, what's the typical sort of rate you charge, and what's the typical failure rate or success rate, to put it more positively?
It's really hard to give you like a generic overview about that. So, in terms of the interest rate we charge, it tends to vary quite a lot. Because if some of the government programmes we run, like RGF and start-up loans, they're quite fixed. So then if we look broadly at the interest rate across those programmes will drop down the average interest rate that our members offer up. For a riskier business that's unsecured, obviously the interest rate is going to be much higher. It is a credit-based risk assessment. So there will be quite a big difference in terms of what the interest rates charge around that. It also depends how our members are constituted financially. So some of our members do receive local government support depending where they are in the country. So if they're operating out of Chamber of Commerce premises or local government premises, obviously that will reduce their overall running costs, and that will bring the cost of credit down as well. So there are a huge number of variables within that. There's also the degree to which lending's attracting guarantees as well, and how that can affect the credit worthiness. So, I think that's why the sort of relationship management is really important, so you can talk through what the different options are and what the cost of that lending is going to be. But it is transparent, is the key point. And what we find with businesses is they won't necessarily, quite often when we present to politicians and we say, well, we're charging 90%, they'll find that very high. But actually for businesses, if they understand the transparency about that, about the cost of overall credit, and if you set that against what some of the alternatives are, especially in the unregulated business sector, to them it will seem, affordable. So that's what we look at, as the affordability as well as the overall cost of credit.
And the success rate?
Again, that varies quite significantly. So where that's most tightly monitored is on regional growth fund, where we have a very tight ceiling on what default rates are allowed to be. And so it has to be those members that are involved in regional growth fund have to keep default rates below 30%. Broadly, the average on our regional growth fund delivery partners is around 15%. But again, that can be really skewed. So you could have, if one big business who's got a big loan goes bankrupt, then that obviously pushes your entire default rate right up to 30%. But overall, you could have one person going bankrupt, but loads of businesses doing quite well. So trying to work out the patterns of that is quite important.
So what are the challenges to you? Raising capital? Does the government need to be investing more? How are you able to raise private money?
So overall, the what used to be called, is broadly known as the CDFI sector, is a model that was imported from America. So in America, the CDFI sector receives $200 million a year of state subsidy. And obviously, America's much bigger, it's a much bigger market, but that has been broadly consistent for some time. If you look at most of our competitors in other countries as well, especially EU, again, they get quite significant subsidy in different ways. So that could be, again, through providing accommodation, through basically running as a government service. In the UK, over the last few years, there's been a real push to make us sustainable without any government funding as well, and to make us wholly reliant on things like tax guarantees and different relief schemes. That is a model that can work, but it can only work by us moving away from the high-risk markets to moving to low-risk markets. So broadly, if you want those high-risk markets to be served, there has to be some way of dealing with first loss through defaults, for example. So yes, we would argue very much that there should be a fund for the sector, because that was the premise on which the sector was set up. But at the same time, we have demonstrated that we can drive very high value out of the sector in the UK, because we are getting used to operating with less subsidy than in other parts of the world.
So I suppose part of the issue is if you're being supported by public money, the Chancellor or whoever it happens to be, local government, whatever, they're presumably risk averse to actually losing the money in the first place.
Exactly so, which is the problem we've found around Regional Growth Fund, is it was designed initially as a fund to be lent to high-risk businesses in parts of the country where access to finance was very problematic. What we're finding now through our monitoring and our relationship with the government is they've tried to drive risk completely out of the programme, which just makes the programme unsustainable. So, yeah, I mean, small business lending is risky. There's nobody, I would say, on this side of the table that would say you can do risk-free small business or even medium business lending. It's how you manage that risk and how you understand the economic impact as well. So not just looking about it, is it default rates, is it interest rates, it's about what is the added economic value of having those businesses that are up and running, especially as you see a trend of people moving out of big employment and working for big employers to self-employment and micro business owners.
But the risk is somewhere between Natasha and you. Where, I suppose, from what we, and obviously from Natasha working it the other way. So where's the line really drawn between the two of you?
In terms of
risk?
It depends how you set the interest rates, really. So you could go for really high risk and charge much higher interest rates, but if there isn't an appetite to see high interest rates, then you have to bring that risk rate right down. At the end of the day, it costs money to provide credit. So, you know, somebody somewhere has to pay for access to that credit. So do you have government subsidy that pays for that credit, or do you build it into the price you charge the customer? It's broadly the sort of, you know, choice you have.
Well, there is another one actually, but we will come on to that in the next question, which is effectively cross-subsidising across a variety of customers, so you can afford difficult business because you've also got very profitable business.
Sorry, Faisel.
I'll try not to repeat, because I broadly agree with everything Jennifer said, pretty much. But if I just add in a few bits. So we're a member of the Responsible Finance Network, Providers Network. We're a responsible finance provider in London, effectively. And we've been around for around 12 years. We've worked with about 30,000 people broadly in London and the South East. And in the last few years have launched a business lending service, which initially started through our 5 branches in the city, but has effectively now gone online, so we've been able to access more businesses in the South East generally and in different parts of the country. So we picked up quite a lot of knowledge around small business lending, and one of the ways that we've often thought about what the CDFI or the responsible finance sector is often described as the kind of the last mile between how the business can access finance, the last space that they get to in order to close those deals. And in order to do that, it just costs more. There's a reason why the banking sector doesn't move that far. There's a reason why lenders don't go that far. And it's usually a mixture of it's too expensive either to get the data or it's too expensive to find those people. And that's why lending in that community is high cost. And our belief is that it's high cost because of the way that people approach it, not necessarily the risk, although the risk is higher because you have less data. And so the organisation we've set up tries to understand that risk, quantify what's really risky by figuring out can you get access to information about the business that isn't publicly available by talking to people, but also building relationships with those businesses to try and understand more about how those businesses work. And I think if you can put those two together, you can begin to have sensible conversations about what risk is. I think if you look at it at a macro level, you're totally right to say there's a kind of a continuum of providers from the banks all the way down to a very vibrant and quite sophisticated range of alternative lenders, of which peer-to-peer are part, different types of lenders are part, and community finance providers are also a part. And within that group, you find that the further down that market you go, the higher the interest rates are. And the higher the interest rates are linked to the cost and to the defaults.
But then that must impact on the potential success of the business, because if you have to spend more and more to finance your business, what might have been viable at a lesser interest rate becomes less viable or less profitable, but the viability starts to affect it as well.
Yeah,
so what could be a potentially perfectly successful business, because it can't borrow the capital it needs, can't be because of the interest rate.
And I think that's one of the things that you often see with
so this is where I come to the risk. That's the assessment of risk, I suppose.
Yeah, and that's what you throw into the mix. So when you make an affordability assessment, what you're really doing is you're looking through the cash flow to understand what really are the finances of the business. And as we talked about it earlier, that many of the small businesses have quite complicated cash flows linked to personal and the business side of it. So really unpicking that is quite hard. It takes time. It's easier not to do. And that's the primary reason for exclusion. Once you've dug into that data, you have to make a judgment call whether the business can afford the risk of taking on the finance and whether it can service the debt. Those are all part of the assessment process. And you're totally right, and I think maybe this links into some of the discussions that some of the kind of slightly odd data that people see, saying, well, there's a lot of businesses looking for finance, but they choose not to take it.
So let's suppose we find a small business where the risk is very low, but they can't get the money anywhere else. They come to you and you have to pay a high rate of interest, even though the risk is quite low.
Well, why would they come to us if the risk was very low?
Because they can't get the money anywhere else. Because the banks aren't interested because they're too small or it's too complicated.
So I think the reality is that there are lots of different types of financial providers, and in the end, most businesses in the UK aren't financed by debt. The ones that are financed by debt are a small portion of most of the businesses. So often debt is used to finance things like specific seasonality of working capital. Mostly businesses are run by equity or people putting their own money in, or not growing. That's generally what happens. If a business was to come to us and we realised that if we lent to them they couldn't afford the debt, we just couldn't lend to them.
Do it, yeah.
We couldn't lend to them. And the advice that we would give to them would be that we can't lend to you because of the cost of the finance attached to it. Either your business metrics need to change or you need to find a different way of financing it, which is a totally credible and valid piece of advice to give to a business, because what we're saying to them is that nobody's going to finance you because of the risk that you're at. They're going to charge you a lot of interest for
A bit
it.
like
So
Dragon's
other
Den.
options.
A bit like Dragon's Den. Somewhere with a flea in the rear, yeah.
Well, maybe not so many dragons, but yeah. Yeah.
Sorry,
yeah, just to, I mean, in your example, that is part of the market that we very much see funding surplus serving. So we have risk bands that go from A+, which is our lowest risk business, where the interest rate is around 4.5%, right up to E, where the interest rate is around 20%. And actually, when you look at the Delphi score of the businesses in the E band, it is still below the average Delphi, above, very crucial, still above the average Delphi score for an average UK small business.
Delphi?
It's a way of measuring credit worthiness. It's Experian and various credit reference agencies would use that as a kind of main way of measuring. And so even in our E-band, actually these are prime borrowers. They're not subprime. They're not. They are as exactly in your example.
You don't have a very high default rate then.
We have about a 2% annual default rate.
So can I just add to that, because actually it's probably quite good context. We start at 20.
Yeah.
And we go up for businesses. Our loans are a bit smaller, so our loans will average for small businesses around £10,000-12,000. So we're looking at businesses that have a turnover generally of less than £500,000. So these are quite complicated businesses to unpick, so they're more expensive. They're also on the higher band of the risk, so we charge from 20% upwards. And in that market, we would probably expect a default rate of around probably between 6 times what the 2% is, so around 12 to 15%, which again would be factored within the cost.
Going back to my earlier question, that's sort of the distinction between what you do and what they do.
Yeah. But I think that's, and I think there's like I said, there's a continuum, and as you go down the continuum, the businesses require different types of interventions.
I think
Yeah.
you're right. And all I would add to it, I absolutely agree with you, that is essentially it. You've got people who will lend at this end of the market, relatively to those rates cheaply, but not everyone will be able to be funded, because as we were describing before, the way in which banks are regulated and quite rightly are expected to lend responsibly, that puts a lot of onus in saying, are you absolutely sure this person can afford to make these repayments? Well, for some sole traders that can be very difficult when the income is more sporadic. So, but banks will, obviously are lending in that space, but clearly not to everyone. And then, as you say, you have others in the market that have a slightly different perspective, and it works its way down through the system. And I would just like to, finally make sure that we don't lose sight of the, when we're talking about rates, that again, a lot of these sole traders will of course borrow as consumers, not as businesses. And when you can, and this is another sort of thing, dynamic in the market, is that if you think some of the personal loan rates available today for certain borrowers anyway can be perhaps 3 or 4%, compare that with the costs on business lending, and people will often put things on credit cards and things and take advantage of payments that way, or you even do credit card swaps and get a period in which you're interest free. So there's you know, there's quite a lot of
can I just add
movement in the market.
Just add something on the rates that we would see that I just wanted to give you a bit of information on. So at the beginning I mentioned typically we see people with sometimes up to 6 debts already. So just to give you a sense of that market and understanding how that risk is profiled, often they are a mixture of subprime and alternative finance lenders where if they are regulated under the Consumer Credit Act, you can get a clear interest rate. And the typical interest rate is around 94% for loans up to £15,000 that we've seen. It can go up to 120 that we've observed, but it can go all the way down to about 49, 50% where you'll often see things like guarantor loans. So it's quite a dynamic market, and it isn't linked to things like the base rate. So there is a lot more complexity about understanding that. But you also asked a question around public funding. Fair finance is a bit unusual in that we took a step away from being predominantly funded by public sources to moving to private sector sources. We believe that there was a market of socially motivated investors who believed that there could be an alternative financial service provider. And we work with a range of individuals, foundations and institutions to finance the growth and expansion of the business. But we also work with quite a lot of the retail banks. So we work very closely with Santander, Royal Bank of Scotland, Metro Bank, and some of the investment banks in London. And what we've found, contrary to popular belief, most of these people are trying to do something quite good and would like and be very positive around supporting alternative finance because they understand this market and they understand exactly why they can't lend there.
Can you give them a good return on the money?
Exactly.
Well, we can give them a return that is linked to what they're willing to charge us, and I think that's quite important to point out because it's a commercial rate of return that proves that we can be a viable business that makes us potentially scalable and sustainable. And one of the biggest problems that we've seen has been a large influx of broadly scattergun approach of public funding without thinking about sustainability. And one of the most important things about trying to understand how do you deal with this market, if you think that it's a few 100 million or a few tens of billions, you need to find a way to access that.
That's the next question. How big is scaling you up? You're not going to be Barclays or NatWest. So where do you start to lose your ethos, for want of a better word, in terms of what you're trying to do ethically and all the other things, and turn into one of these mega businesses? And we've seen this in a different one with housing association. We started off very benign sort of organisations, and now these mega multi-million pound landlords who are completely detached from their tenants. So where is the scaling up going to end?
So for me that's a great challenge, right? So if we believe that the provision of one of the key tenets of the providing our service better that outperforms the market is that it's local, we'd be pretty stupid to get rid of that. Right? Because it wouldn't be a viable, scalable solution.
If you were in a housing association in the 1960s, you'd have said the same thing.
But what we do know is that one of the dangers around growing lending institutions that we've seen in the mainstream market, the banking institution, is that if you move into banking regulations, you are almost predetermined to stop working with poor people. So there is a danger here that you think that we are very careful about, and one of the reasons why we're not a bank or an institution like that is that lending to this community is risky. You need to find ways that adapt to that customer segment. You need the freedom to do so and to do so responsibly. Banks don't have that. No bank will have that because regulation will stop them from lending to risky customers. And that's why people like Funding Circle have done so well and other lenders are moving in this market because that community haven't suddenly been excluded. They've been excluded for a long time. And the banks are no longer ever going to move back into that market. The regulation that we put on them to make them safer and more sound is the reason why we don't have small banks and is the reason why that stays excluded. So for us to keep growing, we have to A, prove we can get to people who are excluded, B, prove that we can lend to them responsibly, and C, be able to convince people that it's a viable business that they can scale. And if you can do all of those, which is what not many people have done, then you actually have a chance to have a really good discussion about, well, how big? And that isn't a discussion that people are having when they talk about serving the excluded.
Andrew, would you just like to complete the survey of interest rates? The Hampshire Community Bank has been lending to SMEs in Hampshire at interest rates between 4.5% and 6.5%, mostly around 5%.
You want to get on to community
I think
banks
yes.
now? So before that, one last question, if I may, to push my luck.
If you can be brief, because we are getting, we need to have time for the...
start to grow. Does there come a point where you do need to be regulated?
We are regulated.
All our members are regulated.
We are regulated under the Consumer Credit Act. I mean, you know, I've taken Fair Finance from 2 people to now 50, and we're about to raise some capital to take us to 100. So all these questions are really pertinent to us, right? How do you ensure values and culture and ethos in the business? And I think if you're not interested in trying to fix the problem from a social perspective, and you haven't considered how you're going to grow to get there, then really you should be doing something else, something much smaller. I think that the problem is massive, it's big. I mean, we talked a lot about it. A lot of your paper talks about the numbers.
So what's your capitalisation now?
So we have a balance sheet that's 5.5, 6 million. We're in the process of negotiating that to 3 times the size over the next 5 years. So it's still small, right? But the point about all of these is that if you can prove what other people aren't proving, that you can service this community responsibly and affordably, you will hopefully convince other people to do so as well. And that's part of the challenge about getting this problem fixed, is that you need more people involved. And that involves convincing investors it works, proving the products work, finding the customers and lending responsibly. And so far people aren't doing that very well.
Thank you. So this now brings us on to looking at community banking, which has been rippling through as another solution sort of through this meeting. Both Richard and Tony are involved in setting up community banks. Richard has led the creation of the Hampshire Community Bank, and Tony is Deputy Chair of the Greater London Mutual. We have all had circulated to us a couple of papers. I don't propose that we look at papers in detail. I think we can all look at those later. But if I can ask, first of all, and Richard, if you go, and they will obviously be published as well. Richard, if you could go first, could you make the case for community banking and explain in particular how a community bank's offer differs from that of credit unions and responsible finance providers?
Yes, I mean, when you study economic performance of many countries across the world, Europe, North America, Asia, it's clear that when you have a lot of local small banks, particularly stakeholder banks, not-for-profit community banks, then that's when industrialization, economic success, high growth takes off, and there's many examples of that. Of course, the same thing happened in the UK. Scottish industrialization only started after many country and county banks in Scotland were created. The same in England. There was, before the First World War, a large number of local banks, and of course the same in the US, where since the 19th century many we're talking about tens of thousands of local banks were created. And also Germany at the peak, 26,000 community banks in the 20th century, going hand in hand with very high economic performance. Just using current data, the most prosperous region in Germany, Bavaria, has a community bank per 30,000 population. So of course for London, we would be talking about several hundred community banks. I would propose to start with 1 per London borough, and try to increase it gradually from that level. So perhaps 30 to 40 community banks initially. And there's many reasons why this is extremely successful. The small firm sector, the SME sector, is a central part of the argument. I mean, if you want to just quickly leaf through some of these pictures.
I wouldn't start looking at slides, because I think it's getting late in the afternoon. I think it's much better that we hear you speak and we have the conversation rather than getting dug into.
So do you mind me asking, we are due to finish in 14 minutes, is that right?
I think that would be 2 hours.
Yes.
Are we okay for?
Yeah, we can carry on. We're booked, but that's the aim, is 2 hours.
Yeah, well, the previous questions have slightly overrun. We should have been here a bit earlier. So are people okay to?
I'm certainly fine to stay if the committee members are. I'm just observing it might be slightly ambitious to get through these 4 questions in 14 minutes.
Yeah. So small and medium-sized enterprises are very important because they're the main employer in any country, also in the UK. Germany is a great example for what happens when you have a thriving SME sector. There is a definition of companies, so-called champions, market champions, that have a number 1 or number 2 or number 3, the top 3 market shares in any particular market niche. And in Germany, there are SMEs that are market champions globally, that are market leaders, and in fact many of them. The majority of German exports in Germany until 2008 was beating China. Anyone was number 1 exporter in the world for many decades. So the majority of exports are due to small and medium-sized enterprises. And of course that's the toughest measure, because that's, it is tough to compete on the global market. But they were able to do this, these small firms, because of their funding. In particular, there's this, so SMEs that are market champions are called hidden champions, and there's a nice graph in there later when you have time. International comparison, and Germany is a complete outlier. It's got 1,320 of these SMEs that are market champions, that have a dominant position in their market niche. And also per capita exports, compared to China, I mean, it's extraordinary. Germany is beating China per capita and any other country as well, based on these SMEs. So the SMEs can only do this because they've always received funding for the last 200 years, and that goes hand in hand with the creation of these community banks 200 years ago, as they were also created in the UK. So the initial development of the UK and Germany are quite parallel, but then what happened in the UK was around the First World War. In fact, this is sort of the Conroy report era. This is from economic historians. The British banking system emerged, quote, from World War I with a degree of centralization unprecedented among major industrial nations. This is 100 years ago, and as you know, the centralization has not decreased significantly. So decentralization is important, to have many banks, because then you take the banks locally to the customer. Face-to-face banking is really how the community banks work. There is another way of, one of the questions was default rates. Many community banks in Germany give unsecured loans. I've spoken to some director of Sparkasse, and he said 40% of their lending is totally unsecured. But they have very low default rates. Why? They know their customers. They are locally. So in London, that would be the local borrower, and they would, people know the bank manager know the borrowers, they know their parents, they all live in the local community, they're part of the community, and that creates also the right incentive structure. When you have what's called transaction banking, anonymous, online, of course psychologists have long demonstrated this, there's a much lower threshold against saying, okay, I'm going to default, I'm going to run, I'm not going to own up to my liabilities, my debt. But when it's face-to-face, when there's actually a personal relationship, it creates a completely different incentive structure. And it goes both ways, because the banks also are not there to take advantage of the customers, because that will get round in town, and the bank manager who does that will get a bad reputation. So you're taking banking back to the human scale. Now, and in fact, the co-op bank is a great example of that. And some of you may have been thinking, are we talking about something like the co-op bank? Well, the problem in the UK with the co-op bank was that it's always been too large and too centralized. It's been half a big bank, and that's far too big. Because when a human organization gets too large, the usual, quirks of human nature start to kick in, and you get wrong decision making. When you get the right decision making structure, the outcomes is when you have decentralized local decision makers that take responsibility and are aware of their responsibility. A local bank manager of a community bank cannot start lending for some crazy projects just because it pays himself, pays him well, because everyone will know about it. When the organization is small, that ensures transparency.
Richard, I'm going to
There's many more points on this.
Because
Can I just ask a point?
Yes,
on
please
that
do.
quickly?
Please do.
You see, I mean, I remember, you know, my family had run small businesses back in the 50s and 60s. All the banks were the big banks you're talking about, but the local bank manager had incredible devolved powers. Yes. Everybody knew who he was. Yes. He wasn't moving every 2 or 3 years. He was a pillar of the local community. He knew everybody. So it doesn't necessarily follow you have to have this sort of structure. It comes to the structures that current large banks were not allowing the devolution and stability in the local branches, which were obviously in those days much more face-to-face anyway.
Yes. No, I agree, entirely agree. But so the question is, why has this happened? Why have the banks decided, okay, we have to end the local autonomy, which did exist, particularly some banks like Barclays, you know, there was like really local autonomy of decision-making, essentially because they've become even bigger and it's rational, it's commercial to centralize further and further and pull out of, you know, the sort of small-scale business that doesn't bring in the money. And these pressures have only increased. So, but we can turn this around by having stakeholder banks. But just one more thing I need to say, so you understand.
One more thing, so you've said it, and then I'm going to move on to Tony.
That is the corporate governance structure. It's very important because, as we saw 150 years ago, there were lots of banks in the UK, decentralised in the country, and so on. But they were for profit, and they were up for sale. And then they will disappear. This is why the challenger banks that, you know, there's lots of talk about them, Metro Bank and so on. In a way, it's not really, it's nothing new, and they will disappear because when they become successful, they will be bought up, or they take over other banks and become big banks. You know, so
Northern Rock.
So
well,
there's nothing you mean in their governance structure that keeps them small.
So the governance structure we have is for the local stakeholders, and this is in Hampshire, the local authorities. So we've got major cities, Winchester, Portsmouth, and so on, as investors. And also there are universities. And by the way, the important thing for you at the London Assembly also to keep in mind, the money does not come from budget. So they invested £8 million, but it's not from budget, it's from reserves. It's a very important point. You know, budget is heavily fought over. This is reserves. Instead of giving it to some of the investment funds to manage, you're investing it locally in your bank. So they've given £8 million, and with that, they get 50% control of the bank, but the other 50% is in the hands of a newly created charitable foundation for the benefit of the people of that local area. And of course, there will be local stakeholders and some from the local authorities and so on, but a mixture in that charity. And this is one of the ways to prevent takeovers, while at the same time being able to gather capital fairly quickly. And we're going to launch by the end of next year with 16 million in capital. And that's all you need. So nobody ever needs to inject more money. And also it's a one-off injection, not an annual thing.
I'm going to pause you at the one-off injection. And
but perhaps one more sentence.
Just one more sentence.
The balance sheet, you have to understand what this means. 15 million in capital you start up with, which is not very much when it's from reserve. But you will, after 5 years, have a balance sheet of over 300 million. That is 300 million in lending to SMEs in the local area, and depositors see that they can support the local SMEs because they're depositing money there and they know it's being used for the local companies, and the returns stay entirely in the local community. So it's a very
fantastic
viable business
Thank you.
model.
I'm going to pause you there. You've had 10 minutes. Tony, you have maximum of 10 minutes. Hopefully you can do it in a bit less. To make the case for community banking and explain particularly how a community bank's offer differs from that of credit unions and responsible finance.
Thank you. Yeah, I'll try and make sure I get on to that second point. Well, I'm going to make some really similar arguments to Richard. We have worked together on research. We both have studied the same things. But let me summarise what I normally give as probably a 20-minute presentation in two. And that is that to re-emphasise that when you, as I have done, look at international comparisons, other industrialised economies, you find that the UK is pretty well unique in its banking structure. Why is it unique? Because it has a certain type of bank that is basically absent. And that is a bank that we have tended to call local stakeholder banks. Such banks have three characteristics. Firstly, they have a dual social and financial mission. They are all there to be profitable, financially self-sustaining. You don't have to keep injecting money. They make profits. That's vitally important. You should not hold a banking license unless you intend to make profits, right? It goes with the territory. But they have a social mission that is somehow embedded in the corporate governance, in the constitution. Ours at Greater London Mutual includes, well, I'll comment on the geographical element, but for example, that any resident of London, any citizen of London shall be given a bank account as long as they don't fail anti-money laundering checks. That would be very different from any other bank with a banking licence operating in the city. It also has a raft of other constitutional provisions about responsible behaviour and socially sort of beneficial behaviour. So that's very important. So that's something that's different from shareholder banks. The second characteristic is a geographical focus. So in our case, there is a boundary, and it is Greater London. It's the 32 boroughs, 33 including the City of London, and that is the patch that is served, right? And that means that unlike any other bank in the capital, that when the board sits down to look at the strategy and operations of the bank, it will think only of one thing, and that is the economic and social welfare of London and Londoners. And that is the only fundamental purpose and concern of that bank. And that would also be unique. So that's a second feature. And by the way, I'm relating it to London, but these banks are present in all our industrial competitors. The third feature is that these banks tend to collaborate in networks. So the London Bank can share costs with banks in other regions because you only need to procure once for example, your major core banking IT system. You only need to draw up one set of regulatory procedures for managing credit risk. So there are ways of gaining cost efficiencies of a large bank, but by maintaining the individual autonomy of the member banks that is so essential for making sure that you are tied to those local markets and to the local population. That is your mission. So these three features of local stakeholder banking networks, so you are present from Japan through Europe, South Korea, America, Canada, everywhere apart from here. Now, it might just be that the UK has hit upon uniquely the best possible banking structure in the world and every other country is wrong. Okay, that is a logical possibility, but I suggest to you that it's unlikely. So that's my pitch to you, that just look at the evidence from overseas. This is a type of bank that almost every industry competitor has. Now, Richard has sort of explained some of the reasons why such banks, other evidence about how they've driven economic prosperity and so on, but how is it different from, and I would argue complementary to, credit unions and responsible finance providers? So I think there are, well, firstly, by virtue of being a bank, being a licensed deposit-taking bank allows you to do two things which we haven't really discussed. The first is provide current accounts. So we talked a lot about lending. The credit union submission rightly talked about encouraging saving. Obviously, these are important features of a community bank too, but community banks offer current accounts. And one of the main forms of financial exclusion for businesses and particularly individuals is being unable to access a fully functional bank account. The poverty premium that's calculated by JRF is currently £479 as an average of being the cost of not having access to a fully functional bank account. So part of the mission of the GLM would be to ensure that every customer, and the reason why we can do that, by the way, is we would have a monthly charge for it. So as most credit unions, well, there are very few credit unions that offer a current account, but where they do, they charge for it. Triodos's new current account will have a monthly charge. This is the way the market's moving. But that will still be much cheaper, that monthly charge, than not having a bank account at all. So being able to offer a current account is a key difference to most credit unions and all RFPs, because that's not what they do. Secondly, this is very important, it gives you, as a bank, you have access to a stable and very cheap form of finance, namely customer bank deposits or savings, which is a form of finance which is unavailable to these other alternative providers. And I would like to think that Londoners deserve to have the choice of thinking, if I want to put £100 on deposit at a bank, I know I can go to NatWest and £4 of that, £100, will be funding SME lending, of which a very small proportion of that would be in London. Or I could deposit £100 in the Greater London Mutual, and £33 of my money will be supporting London SMEs. I think that's a choice that Londoners deserve to have. quite simply about what you do with your savings. So I think that those are, and credit unions they are allowed technically, but very few of the credit unions do SME lending. So those are two important complementary features of a community bank that I think add to the existing provision that responsible finance providers and credit unions can give.
Thank you, and admirably concise. Can I ask you both what precisely you think a London community bank would do for London SMEs? So how would it kind of actually help?
Can we slightly rephrase the question?
Mm-hmm.
A London Community Bank / several
Or
community banks, yes.
Because
access to community banking in London.
Yeah. Could I also, as part of that question, would you lend to the people who are at the bottom end, like Jennifer and Faisel lend to?
Yeah.
In most countries they do. In most countries where there are community banks.
We're talking about real proposals here.
Yes, absolutely.
Richard, do you want to go first?
Yes, thank you. So what would the community banks in London do? Well, they would offer the opportunity for Londoners to lend to banks, because when you deposit money, you're lending it to the bank. That is lending it out ethically and sustainably for productive investments in the local SME sector, geographically restricted. So if there's several boroughs with, each has their community bank, then the lending would be in that local borough only. And that is worth a lot. Also, the bank would offer better conditions, and we heard the comparison of interest rates. The community banks would not discriminate. I don't think you would see any double-digit interest rate, per annum interest rate on any lending whatsoever. That's unheard of. I've never seen that from any community bank. Because, well, as Tony pointed out, the bank has access to very low-cost, zero-cost funding as a current account provider. And also the community banks are structured such that there is not, some greedy, hungry shareholders that want to extract high dividends and they need a high return on equity. So therefore, the community banks are able to charge only modest interest rates. And as I said, the Hampshire Community Bank has been lending to SMEs in Hampshire, and it's been around 5%, some below 5%, but there was none above 6.5% so far. And so that's, with current market conditions, I think a reasonably accurate description of what the lending profile would look like. And it would be lending diversified across the sectors, and it would be lending to consumers as well. There would be mortgages. Because the other thing is to understand is these community banks, unlike credit unions, they are full-blown banks that offer the full range of banking services, so that you can actually, switch your accounts. You can leave the big banks and switch to the community bank because they will provide everything for you.
And Tony?
Great. So, just to pick up on that point, another thing that a bank can do sort of SMEs is, because you're a bank, you're offering both the current account product, you're able to offer term loans, but you can also offer overdrafts because you have a current account product. So you have a broader range of financing options to suit a business, which aren't perhaps available to some other alternative finance products. Having said that, I think one area we haven't talked about in terms of SMEs, and I know this is possibly disputed by perhaps representatives of larger banks, but there's talk of these sort of happy non-seekers of finance. Actually, if the Federation of Small Businesses were represented here, I suspect they would talk, as they did in the Banking Futures project, quite a lot about, and I've experienced this personally as well, businesses that actually could take finance in the form of debt to either invest in improving their productivity or indeed in growing, and they're not. Why aren't they? Because, you will not drag me to that bloody bank, with wild horses, because I know what they did to my mate down the road who was put out of business. The levels of trust are catastrophically low. Now, it has got better, and I'm not here to bash banks because they have, done lots of initiatives to sort of improve customer service and so on and restore trust. But nevertheless, there is still an issue of trust, particularly at the smaller business end. That's why a bank that has a different ownership model and a social mission, whether it's a Richard model or ours, which is a true cooperative. The Co-op Bank wasn't a cooperative. A legal change that was very recent has only just allowed cooperatives to actually be banks in this country. So the Greater London Mutual would be the first true cooperative bank. But if you are a small business, you're actually a part owner of the bank. The customers own the bank. That changes the trust dynamic. And we think that there is lending, profitable lending, currently not taking place because actually there are businesses, SMEs in this city that just wouldn't want to go for finance for a bank. Now maybe if they knew about it, they could get finance off other people represented at this table. But London's a big city with a lot of SMEs and a lot of banking business out there. And I think there's room for everywhere. And I think a customer-owned bank is something which will add to the mix that will sort of restore trust amongst SMEs to the banking sector. So I think that's the thing I'd point to in addition. And just finally, just if you think about lending, I'm not sure Mike would recognise this. I mean, really, and Faisel and everyone is that an SME lending proposition, a lending proposition, there are kind of three pots. There's a sort of fairly easy yes, there's a fairly easy no, and there's a bunch in the middle which is okay. This we need to think about a little bit more carefully. Now, larger banks have graduated towards high volume processing models that deals with easy yeses. To an extent, peer-to-peer, as we've heard, with dealing with high-quality credit, have sort of got really efficient ways of dealing with easy yeses, doing it really quickly and with high customer service. Nobody should be lending to the nose, and Faisal talked about the irresponsibility of lending money to somebody who can't repay it. Nobody wants to do that. But it's that grey area in the middle that requires models that will allow you to develop deep market knowledge, to somehow fund the customer relationships, which RFPs also do, and Faisal does, or have some other way of cross-subsidising or embedding it in your social mission. In our case, it's a case of an element of cross-subsidy because we don't need to make higher returns on equity to satisfy shareholders in the city, that we can have some profitable middle-class customers that we serve, and that allows us to, to bear the high transaction cost of getting to know the smaller loan customers, but still able to serve them because it's part of our mission. So you have to find some way of getting more into that grey area, because in that grey area are profitable, economically viable, important lending decisions that are not getting made at the moment, because that's just too difficult. It doesn't fit the models, of the big banks. And that's not the big banks' fault. It's just a reality about their models. And that's why these other economies have these kind of banks. And they make money and they make economic benefit out of that grey area. And I think that's where we would try and sit.
Can I just go back to the to individuals? So you talked about, providing making money from the stable middle class banking where people may be taking a loan to get a car or sort of do some work on their home or something, but they're reliable in terms of paying it back. What about the more financially excluded individuals, the people who are paying the poverty premium, who might be using a credit union? Partly, are you in competition with those credit unions? And also, if you are providing financial sort of a bank account to every Londoner, which will include people who would at the moment be financially excluded, how do you help them to manage their money and not get into overdraft and etc.?
That's a good question. So our current account product has a couple of features which are not generally available from high street banks. The first is jam jar accounting, which you may well have heard about, but it's the ability to ring fence money as it comes in. So universal credit, as we know, is sort of causing havoc around the country. One of the reasons is making it far more difficult to budget. So once you get your monthly payment, if you can ring fence a certain amount for the rent and a certain amount for other bills, ours allows you to put it into pots. We also plan to have a financial literacy and sort of programs that work preferably with partner organisations, which we can help to assist people in being sophisticated around budgeting. But a good product helps. Also, there's, this is quite technical, but there's a sort of cheaper version of payment system that you can subscribe to, which is updated occasionally. But there's a 2-hour gap, so you can go down the high street, pay for lots of things on a debit card, and go quite considerably into overdraft. Ours is the more expensive version, which is real time. So basically, it doesn't let you inadvertently go into overdraft. We're trying, because it's part of the mission, every single product decision you're making is how can we help people manage their money, which also, of course, reduces our risk, because if we help people manage their money, then the danger of unauthorised overdrafts, for which, by the way, if it did happen, we would charge no fee, because we have one flat rate, no hidden fees, no charges for a bank letter, no unauthorised, nothing, really transparent, simple monthly fee. So helping people to manage their money is really important. And I just will point you to some statistics that show out of the people that don't have currently a full bank account. But a third of them say it's because they prefer not to use them. Now, that's curious. Why? I would suggest it's a combination of not trusting banks or that the product isn't very good for their needs. Actually, because if you budget with cash, it's really transparent and immediate. You know exactly how much you've got left. You can put it into different pots. It's a really good budgeting tool. Cash is brilliant for managing your money, right? So what you need is a current account product that's as good as that. And that's what Wales is trying to do. The second most important reason is that people haven't got the correct ID. So that's again, it's an efficiency point. If you're dealing with, Lloyd's probably, I'm guessing, has something like 15 to 20 million current account customers, right? So you're a high volume business. As a smaller bank, you are happy to spend the time with that customer with unusual ID. And in a city here with high immigration like London, which is vital to its culture, this is really important in London. So you have people arriving here with what's called a thin credit file. They don't have the standard forms of ID. But actually, with the right intention and with the full list of allowable by the regulators ID forms, we would get them over the bar and get them a bank account in a way that high street banks, that's not going to work for them to spend that time with that customer. We will absolutely be trying to make sure we give those people, because it's in our constitution.
Just to add to this, the Hampshire Community Bank has the model of not offering any products at all, only services. And so there's also no sales targets to sell products. Staff are able to explain all the services across the range. And so the personal contact is very important, and also the high level of training that staff receive, so they can give advice, and they're not under pressure to close some deals and reach some sales targets of selling products, because there are no products. It's service, and it's what's in the interest of the customer.
Thank you. I'm very aware of the time.
Can I have a question on
Yeah.
You painted this wonderful picture. You've been bigging up how wonderful it is. I just want to.
No, I've tried.
I'm a practice the sort of sceptical member about this. I'm not. I just want to be. Two questions really. What is potentially the wrong thing about community banking? Because it can't be 100% perfect. And if it is so clever, why hasn't it happened already?
There's perhaps a question we should ask at the lobbying power of the City of London Corporation. Actually, the City of London Corporation is a great example for the creation of a community bank for the benefit of the community of the City of London. In 1694, the Bank of England is a private for-profit community bank. And you see, it only had one customer, because if you have such large community banks, you will only have one customer, the government. It only lent to the government, not to SMEs. So, of course, we need more community banks. And the Bank of England is a great model of a community bank, which is London, of course, deserves many more. And there is actually a direct link to another point that hasn't been mentioned. Banks, unlike non-bank financial institutions, do not lend existing money. They create new purchasing power that adds to the money supply. And that means the more community banks London has, the more money will be created for the benefit of people in London and businesses in London to use productively, and therefore
it's not inflation.
Your gross value added will go up, your GDP will go up, your job creation will go up, because other schemes, and this is true for non-bank financial institutions as well as other schemes, like local currency schemes, they transfer purchasing power from one area to another, whereas a local bank with a proper banking license will create new purchasing power.
Andrew, we are really overrunning. I'm very aware.
Natasha wanted to say something.
Yeah, I just had one really quick question, which is, do community banks have to hold the same level of regulatory capital.
Absolutely.
Yeah, probably more.
And kind of to your question, Andrew, I suppose one of the reasons why we think online lending is a much more efficient way to get finance to small businesses is because investors are lending directly to businesses. We don't have, and we're not lending off our own balance sheet. We don't have to hold the same regulatory capital as banks do, and that's why we think the model is inherently more efficient.
So what's vital, and the British Business Bank has now put as one of its objectives, is diversity of models. Right? There is no, I would argue, there is no model here that is superior to any other model represented in this table.
Not at all. No, that's
So,
not what I was suggesting.
no, indeed. But that relationship. So a proportion of the market can be very efficiently served entirely online with algorithm-based business models. But there's another portion of the market that must have relationship-driven banking. And Handelsbanken, by the way, has proved this has been a runaway success by having the bank manager, the church spire principle, who knows his patch. Right? I mean, their default rates are brilliant. I mean, they've tended to go for
but they don't tend to go for the what I would call the financial exclusion.
No, they didn't. No, indeed, no, they didn't. Well, I mean, but the point is that it shows, and they're a private business that with you know, the quoted company in Sweden. But it proves that actually the importance of relationship management for certain kinds of lending is still true. So you need to have both new fintech-driven models and you need to have relationship-driven models. And the reason why we did have them, and Andrew, and just in this country, but only in this country, it was decided that it was better to allow economies of scale to arise through them all being merged into one. In other economies, they gain those economies of scale by collaborating in the networks and sharing back office costs. And that is proved in the long run to be a superior model.
I think we are going to have to move on to our final question. And I'm going to, sort of in particular, Faisel and Mike, I'd be interested in if you've got anything particular to comment on the community, what's been said on community banking. But for all of you, to just if you've got an inspiring idea of what you think the Mayor should be doing, what he should be focusing his attention on in terms of supporting smaller businesses to achieve, you know, long-term resilience in our city. So should we start at that? Faisal, are you ready to go, or would you like a moment to think? Shall I go? Yeah, Mike, do you want to go?
I won't just sum up, you know, what I was saying earlier, that you know, the evidence base suggests at the moment that certain access to finance for SMEs doesn't seem to be, you know, hugely problematic. But I think if we were going to do anything at all, you know, to my earlier point about the needs of those who are in that I described as steady state, you know, then I think if he can, you know, if he has a role in, you know, supporting finance and advice, you know, to that particular group and make it easier and more accessible, you know, I think it would probably be welcome.
Do you have any advice for the Mayor?
Well, only to implement the suggestion.
Natasha?
Well, like I mentioned, a number of local authorities are actually lending through the platform, using their treasury funds to earn an attractive, stable return, which they then reinvest into the local economy. So that could be something that the Mayor could consider, is to lend through the platform.
Thank you. And
yeah,
idea for the Mayor? Yes, go on.
I would suggest that the Mayor puts 10 to 15 million pounds into the capital for the establishment of a community bank in each London borough. So 32 new community banks can be set up with what is actually a fairly modest amount of money.
Thank you.
So I think it's interesting, and we always welcome competition, and we're entirely relaxed about it. I think it's quite interesting that the community banking model is set out. It's very reliant on access to cheap capital, and certainly as a sector, if we had access to cheap capital, we could scale really quickly. In our submission, we talked about, earlier I talked about Northern Powerhouse, Midlands Engine Funds. These are tried and tested in other regions. So I think certainly the Mayor thinking about a London enterprise fund would be really welcomed.
Well, the question is the Mayor's role in promoting and supporting financial inclusion. And if I may, I would sort of suggest that is part of his role to set a degree of vision for London and London economy. And I would suggest that vision should include the idea of a bank which, or indeed banks, that are specifically for the benefit of London and Londoners, that specifically has a social mission that includes for financial inclusion. That has a commitment, we haven't talked about this, to maintaining a branch network to ensure access for all those citizens who still do need branches. That will keep money, so it has a geographical lock on the money, so it continually circulates within the capital. And in which, in our case, because we're a cooperative, each customer, each member is treated with equal respect, because it is one member, one vote, regardless of how much money you have in your account or how many shares you hold. And I would suggest that my recommendation to the Mayor, which is rather similar to Richard's, is that were you to make available a capital fund on which you will get your money back with interest eventually, available to capitalise such bank for London or banks for London, that may well turn out to be the best investment you've ever made.
Faisel.
So you said you asked in reflection on the community bank, but also around the recommendation to the Mayor. So I guess in reflection on the community bank, only in the sense of it sounds like a great idea, but I think the focus of the problems of financial exclusion don't seem to be a banking problem. It feels like a product problem. So I guess my recommendation is there are lots of interesting and innovative product designs happening in London, and what the Mayor has, he has the ability to convene many of the people who are concerned and would like to fix that problem, whether they be banks, tech providers, corporates or non-profits together. And I think by doing that you can get over some of the challenges of better product design, better service delivery, but actually working with people who are already engaged with those kind of communities. So my recommendation would be to convene and to bring those people together, because if you can surface up some better ideas, you might be able to fix the problem.
Thank you. Thank you, everyone, for your contributions, and I'm sorry to have been so bossy about trying to get us through, and I'm really sorry we've overrun so much. Can I finally ask the committee to note the report and the discussion with our invited guests and delegate authority to me as chair to agree the output for the scrutiny review of the Mayor's role in promoting financial inclusion? Thank you. That's the end of our meeting.
When are you going to use that?
I used it at the beginning as well. It's
GLA, Committee Room 5, Sound.